It's hard to like bear markets and it always comes with a drop in your portfolio. But a bear market isn't all bad. They can be an opportunity for investors. As the stock market continues in its downturn, who better to lean on for investing advice than legendary investor Warren Buffett? Welcome to the From Zero to Wealth channel. If you're new here, this channel provides you easy to understand information about wealth creation through personal finance and investing, teaching you what schools should have. And if you're returning, welcome back. In this video, we'll be looking at what dollar cost averaging is, how it works, what the benefits are, and how you can make the most of dollar cost averaging. Warren Buffett has put together an investment strategy that anyone can adapt and use. He once said, "If you like spending 6 to 8 hours per week working on investments, do it. If you don't, then dollar cost average into index funds." Dollar cost averaging is an investment strategy in which you invest your money in equal amounts and at regular intervals. This way, you manage your price risk when you're buying stocks, ETFs, or mutual funds. Instead of investing in a particular security at one time with a single purchase price, with dollar cost averaging, you divide up the amount of money you'd like to invest and buy small quantities over time at regular intervals. This decreases the risk that you might pay too much before market prices drop. Prices don't only move one way, of course, but if you divide up your purchase and make multiple buys, you maximize your chances of paying a lower average price over time. In addition, dollar cost averaging helps you get your money to work on a consistent basis, which is a key factor for long-term investment growth. Also, your average unit cost will be lower and you will be eliminating the risk of investing in the market at the wrong time. Many people have attempted to time the market and buy assets when their prices appear to be low. This sounds easy enough in theory. In practice, it's almost impossible, even for professional stock pickers, to determine how the market will move over the short term. Today's low could be a relatively high price next week, and this week's high might look like a fairly low price a month from now. And trying to time the market can really cost you. According to research by Charles Schwab, investors who try to time the market saw drastically less gains than those who regularly invested with dollar cost averaging. Dollar cost averaging takes the emotion out of investing by having you purchase the same small amount of an asset regularly. This means you buy fewer shares when prices are high and more when prices are low. So, how does dollar cost averaging work? Let's look at some surprising advantages of dollar cost averaging. The first scenario, we see a chart where the price market is moving up consistently or stays the same. We are investing $250 a month into an index fund and invest for a period of 8 months. Notice when we first start, they are $10 a share. So investing with $250, we get 25 shares. And then next month it goes up to $35. Notice that we get fewer shares when the price goes up with the same invested amount. We now get 7.14 shares. Then it goes up to $40 a share and now you get 6.25 shares with an investment of $250. The next month it stays the same. The month after it goes up to $50 a share and now you get 5 shares. And for the following months, the price stays there for a little while. This is the investment that everyone would like to have because it consistently goes up in value. When we add all of our shares up, we have a total share of 64.64 at $50 a share. Total investment is $3,232. The second scenario, the chart shows lots of volatility. Volatility means how quickly prices move up and down over a given span of time. Just like the first scenario, it starts with $10 a share and we'll get 25 shares. Then it goes up to $35 and the month after the price goes up to $40 a share. Now the emotions start coming in because the market starts to crash. it goes down to $8 a share and will get 31.25 shares. And it keeps dropping to $5 a share, which gives us 50 shares. The price stays the same for 2 more months. In the last month, it finishes to $25 a share. So for this scenario, we have a total share of 229.64 at $25 a share. Total investment is $5,741. Notice it finished at half of the value compared to the first scenario. But because the market was down for a while, it gave us the opportunity to buy shares that were on sale. We got to buy more shares. This scenario is actually a better investment than the first scenario. This is the concept of dollar cost averaging. When the market is down, we don't panic and we keep investing the same amount of money as we did previous months. In the long run, it actually helps you. What are the benefits of this investment strategy? 1. It reduces risk. Dollar cost averaging reduces investment risk, and capital is preserved to avoid a market crash. It preserves money, which provides liquidity and flexibility in managing an investment portfolio. 2. It rides out market downturns. Using the DCA strategy by investing smaller amounts every period in declining markets assists in riding out market downturns. The portfolio using DCA can keep a healthy balance and leave the upside potential to increase the portfolio value in the long term. 3. Disciplined savings. The strategy of adding money regularly to an investment account allows disciplined saving, as the portfolio balance increases even when its present assets are depreciating. 4. Prevents bad timing. Market timing is not a pure science that many investors can master. Investing a lump sum at a wrong time can be risky, which can adversely affect a portfolio's value significantly. It is difficult to predict market swings. Hence, the dollar cost averaging strategy will provide a smoothing of the cost of purchase, so it can benefit the investor. 5. Reduce emotional investing. The use of DCA eliminates or reduces emotional investing. A disciplined buying strategy through DCA makes the investor focus their energy on the task and eliminates news and information from various media about the stock market's short-term performance and direction. It takes all the thinking out of it. You don't have to worry about emotions. It doesn't require you to time the market, and you don't even have to know anything about the market. All you do is consistently invest the same amount into, for example, Vanguard S&P 500. In order to make the most of dollar cost averaging, start using this strategy as early as possible. Dollar cost averaging instills the practice and discipline of investing regularly. The earlier you learn this particular lesson, the greater the potential for gain over the long term. It's also effective making dollar cost averaging a very practical strategy at the start of your education career, when you're typically lower on the pay grid. Invest consistently. One of the things that makes dollar cost averaging effective is consistency. So, pick how you want to invest, whether that be weekly, monthly or quarterly, and stick with it. Otherwise, you'll end up saving at different ratios, which will cause inconsistent returns over the long term. And keep calm and carry on. It may be tempting to abandon this strategy when the markets get turbulent, but resist the urge to pull the plug. Doing so means going back to trying to time the market, and that is exactly what any financial advisor would disagree with. We hope you have a better understanding of dollar cost averaging. Thanks for watching, and don't forget to subscribe for more informative videos on personal finance and investing. Like and comment down below if you enjoyed watching. Turn your bell notification on, and we'll see you in our next video.